Hello, everyone, and thank you so much for joining today's Family Office Access Masterclass. I'm Danielle Patterson, Executive Director of Family Office at ISS Market Intelligence, and I'm grateful that you're all here. Before we get started, I've enabled the chat. You can see everyone's introducing themselves. Feel free if you haven't, let us know where you're joining. It's always so fun to see what a global community we have and different roles located. So feel free to drop your role and what you're here for. Today's session is one I have been looking forward to. Our guest is Ron Diamond, founder and chairman of Diamond Wealth, and one of the most respected voices in the family office world. Before I share a bit about Ron, for those newer to the space, I also wanted to share something personal. So Ron, over the past few years, you have been more than just a speaker in our programs. You've been a mentor to me, a sounding board, someone who's just always been there to offer value and shape how I understand the industry. And you've really been kind of a North Star in why and how I've shaped these educational programs. You've introduced me to so many incredible people, and you've encouraged me during my moments of transition. You've helped introduce me to Cody, who helped with our rebrand. And it's just an amazing example of how to show up with generosity and insight. And I know I'm not the only one that feels this way. You have an amazing following. You can tell by the 144 people who are here, and these numbers keep climbing. But it's just so many people across the family world, office world look to you as a guiding voice, myself included. And so I couldn't be more grateful for the opportunity in today's conversation. So I
Well,
didn't want to
thank
miss the opportunity to thank you.
thank you. Thank you for saying
Yes,
that. It means
of
a lot.
course. Oh, well, anyone joining us who may be newer to the family office space, I just wanted to give a little context on Ron's background. It would take me a long time to read the whole bio. He has that much experience, but just to kind of lay the foundation, Ron has spent more than 2 decades working with family offices, not just advising them, but investing alongside them across private equity, real estate, venture, credit, and special situations. Through Diamond Wealth, he works with a syndicate of more than 100 family offices, ranging from a few hundred million to tens of billions in assets. He's also built Family Office World Media to help collaborate and share knowledge. He's helped establish the Family Office program within Tiger 21, one of the most respected peer networks for ultra high net worth investors. And I can go on and on. He has board roles, and it's just he's always up to something new with a educational programming. But I'm not going to read the full list because I want to leave room for Ron today to explain really what he's done and what he's currently working on. But ultimately, what matters most, Ron has spent years inside the rooms where family office decisions actually happen. So we're going to get to hear from the inside. And this session is designed to be interactive. So that's why we host them live. We want to fold you into the conversations. I know ahead of time I did get a few questions submitted, so we'll make sure to weave those in. But yeah, please, thank you everyone for joining and being eager to learn for Ron. With that, we'll go ahead and get started. So welcome.
Always great to be with you, Daniel.
Likewise. Thanks, Ron. So instead of just, going over your resume and starting from the beginning, I kind of want to look back at the industry as a whole. After seeing everything you've seen in this space, working intimately for 20 years, what still surprises you about family offices today?
That the model doesn't work. That we're still at roughly 25% making it to the second gen and 10 to the third and 5 to the fourth. How fragmented, siloed, inefficient the industry is as a whole. I think that's starting to change, but I mean, you've got 10 trillion in capital in family offices, but the real number is 124. You got 124 trillion moving downstream from the baby boomers to the next gen in the next 20 years. So we're about to experience the largest transfer of wealth ever. And it's going to do two things. One, from a business standpoint, it'll fundamentally change how companies are financed, period. So as private equity and venture capital disrupted the public market in the late 80s, it was a better model. I believe family offices are going to disrupt the private equity and venture capital model because many of these, it's become an AUM game and there's a little bit of a conflict of interest. But my North Star, you know, people look at family offices and they say, well, the rich are getting richer and the poor are getting poorer. And that's a bad thing for any society. And without a sustainable middle class, bad things happen. But the positive to me is that I don't think that it's not a panacea. I don't think family offices are going to solve all the world's problems, but I think they're going to solve many of them.
Mhm.
So just a couple examples, and this is kind of my North Star. My
Yeah.
dad, who was my hero, passed from prostate cancer when he was 57 years old. And at the same, right around the same time, my first boss was Michael Milken at Drexel, who was a visionary, and he developed prostate cancer. So what my dad did is he went to 3 or 4 doctors and got second, third, fourth opinions, and he lived 3.5 years, and then he passed. What Milken did, and this is why I'm so optimistic about the family office space, he did this through his family office. He went to 3 to 4 doctors, but he also built it almost like a venture capital firm. He put 2 million here, 500,000 here, 350,000. So as because of him, myself and most men, if we live long enough, will die with, but not of prostate cancer. Fast forward 30 years, forgetting anything political with Bill Gates, I would argue he did more for COVID than the US government. Eric Lefkowski, his wife had he was a founder of Groupon. His wife had breast cancer. He ended up starting a company called Tempest, which is now a publicly traded company, multi-billion dollars. He didn't do it to make money. He did it to solve a problem. And then Sergey Brin has a predisposition for pancreatic cancer. Is he going to solve it? I don't know, but I put my money on him over the American Cancer Society. So my North Star and why I'm so optimistic about this, while even though it is a bad thing from a societal standpoint for the rich to get richer and the poor to get poorer, I think there's going to be so much good that comes out of it, and that's my North Star.
You know what, Ron? I love that you see through that lens because I've learned from you and I share that viewpoint. And I know no two family offices are quite alike, but I think taking that approach and that outlook and through the masterclass interviews we do, we focus on those who are making a positive change and we elevate them because they're leaders. And so I think it's an awesome outlook to have, and I think it can really change the world for the better when we follow that North Star, your outlook, and we really celebrate the families that are using their wealth to make impact. So the term family office, I know even a family office may define it in a different way. And it's something now at my role with ISS where we really analyze the data. We try to categorize and give names. It's complex, especially in the world of RIAs and how there's sometimes now crossover. What does the word family office mean to you, and how has that changed over the years?
It's a great question. I gave a keynote at Stanford 5 years ago, and I literally had 5 multi-billion-dollar families on a panel with me. And I asked each of them, what's the family office and why did you create it? And
Hmm.
I had 5 completely different answers. So, and nobody was wrong, nobody was right. But right now, you hear the term family office, it's used over and over, but what does it actually mean? How much money? There is no playbook right now. So, in order for it to make economic sense today, in order to have a family office versus going to a multifamily office, if you're going to invest in the private markets with private equity, venture capital, real estate, credit, sports teams, special situations, you need a bare bones minimum of about 500 million. Otherwise, you're better off going to a multifamily office, the Cressets of the world. That's why the multifamily offices were created. But having said that, there are a ton of family offices that are under 500 million. I don't judge anybody on anything. If you sell your widget company for $50 million, that's a ton of money. It's
Right.
just not enough to have a family office. And if they want to start a family office, I'll tell them they shouldn't, but they could do whatever they want. So there's no real playbook for family offices. What it's supposed to be, I mean, the Medicis really were the first family offices, goes back a long time. But in the US, it's probably the Rockefellers and the Vanderbilts in the late 1900s, 1800s. But I think that the interesting thing is 68% of the family offices that exist today started since 2000, and half of those started since 2008. So this is a very, very new industry, and people are really trying to figure out what is it. And every service provider, every bank, every law firm, every accounting firm, they're all trying to get into the space because that's where the money is.
Right.
And it's a very fragmented and siloed industry that has to change. I think it's going to change, and I think we're at an inflection point. We can touch on that a little bit later.
Yeah.
But I just think that the word family office is used over and over, and it's misused constantly.
Help us understand too, because I know the recommended assets under management to efficiently, properly run a family office seems to be increasing over the years. Can you touch on really how much you think it takes to run a successful family office? And where is most of that cost? Is it in the talent? Speak to us a little bit about why maybe a 50 million in assets family office really shouldn't exist.
Well, if you do the math, if you reverse engineer it and going back, um, if you have a single family office, you're paying for your own accountant, your own admin, your own legal team, your own staff, your own deal people. Um, that's expensive.
Yeah.
It gets very expensive. And so if you do the math, you really do need about 500 million in order for it to make economic sense to have a family office. The multifamily offices were created for typically for families between 10 million up to four or 500 million dollars. And that's really where the growth is going to be. The interesting thing is, I think there's going to be huge growth in the multifamily office. What's happened is post crash, pre COVID, we had a lot of family offices who did direct deals. And if you post crash, pre COVID, I don't care what you invested in. Private equity went up, venture capital went up, interest rates were zero, so real estate wasn't easy, it was easier. Stock market went up, Bitcoin went up, everything went up. So what a lot of the family offices did is they said, you know what? I'm going to bypass these experts and I'm going to make money and I'm not going to pay any fees. And they were right until they were wrong. And
Love
then
that.
3 years ago, when they started jacking up interest rates, now you see a lot of family offices not only not making money, but actually losing money. So I think the trend is going to be a lot of these single family offices are starting to reevaluate what they do in-house and what they outsource. And I look at the large multifamily offices like the Crest of the world, they're going to gain a lot of market share because a lot of these single family offices probably shouldn't exist. I make the comment, and I believe this, that roughly 85 to 90% of the family offices that exist today objectively shouldn't exist. And again, I don't judge anybody. You can do whatever you want with you sell your widget company, do whatever you want. But I think they'd be better off. And I think we're at an inflection point where families are just starting to become more professional, just starting to institutionalize a little bit more. But I used to think we're in the second inning and some the third inning. Sometimes I
Yeah.
think we're back in the second. Sometimes I think we're in the first. So
We're just getting started on some days.
it's a
Yeah.
fascinating market.
Well, it's amazing the way that you are advancing the sector, and we'll hopefully get time to talk about what you're doing at Booth. But before we leave this topic, one of our attendees, Justin Albertson, and thank you. I know people may have been dropping questions in the chat, but it's so busy, it's hard to monitor. The Q&A is enabled, and if you're unfamiliar with Zoom, it's at the bottom. But Justin dropped in there, when you say don't make it to the next generation, what happens?
Well, many times there's lawsuits. Many times the money disappears. It's not thoughtful. I mean, a family office, it's supposed to help. You're supposed to help with the estate. It's supposed to help with the family. It's supposed to help with investments. It's supposed to help with philanthropy, and it's also supposed to help with next gen.
Yeah.
So what happens is somebody has a liquidity event, and remember when Rockefeller and Vanderbilt did it in the late 1800s, it took decades to create wealth. With the internet and now with AI, you can create an app and you can become a billionaire literally almost overnight. So the speed at which it can happen is magnified by 1,000. And you've got a lot of these families right now that are doing it. And I think that what they do is they have a liquidity event. And the first thing they start doing is it's in the paper. So if you're
Mhm.
in Menlo Park or if you're in Pittsburgh, Pennsylvania, everyone sees you sold your company for $1 billion. The first thing the vast majority of people do, they start investing. Their friends hit
Right.
them up, the private equity, and that's the last thing you should do. But there is no playbook. The first thing you should do is something called governance. And a lot of
Mm.
people who have family offices don't even know what governance is. The second thing you should do is talk to an estate planning attorney. Your
Mm,
estate planning attorney, certainly in my opinion, is more important than your money manager because it's kind of structural alpha. Then you need to get the succession, next gen, philanthropy. Once you get all of that right, then you should start investing. But there's no playbook that says sell a
wow,
company for X and then do A, B, C, D, E. We're trying to change that, and we're putting together a program at University of Chicago Booth to do that.
that's
But we've
amazing.
got a big lift to do that.
I'm sure. And it's hard because no two are quite alike. They come from different industries, different area of expertise, but that framework becomes so important. It's becomes, yeah, the foundation. Yeah, the next gen, that's something I'd love to dig into. And I know the wealth transfer is huge. And I'm curious from your vantage point, do you see the next gen engaging very differently than their parents?
Yes. I think from our gen, we're roughly the same. From our generation to our children's generation, there's never been a bigger change in a generation. You can go back to the Industrial Revolution. I mean, I had a typewriter in college with a Smith Corona whiteout key. We had a computer lab class for half an hour. Um, I don't have the internet. I have something called the Encyclopedia Britannica. So if you look at how everything has changed, there's been a bigger change from our generation to our kids than there's ever been, and it's growing so quickly. And now with AI,
Oh,
it's
yeah.
it's changing at light speed. The the negative is there's positives and negatives in everything. I think Jonathan Haidt wrote a great book called The Anxious Generation, I think everybody should read this book. It's a phenomenal book. And what he talked about was the amount of like stress, anxiety, depression, and even suicide amongst the 18 to 25-year-old cohort is literally off the charts. And
Yeah.
why is that? And he traced it back to the phone.
Wow.
When I was done with school, I'd come home, I walked home, and if there was one person out, we'd shoot hoops. If there were three, we'd play two-on-two baseball. If there were six or eight, we'd play football. Right? We just do stuff. I think this generation, they're spending like 7 hours a day on average on the phone and screen time. And we're not wired to do that.
No.
We're not wired as a species to be behind a computer screen. So while we're doing now, Zoom, where I could physically see you, is a lot better than doing it on the phone. It's 1,000 times better doing it in person because there's an interaction, and I think this generation is missing that. I think it'll play out interestingly in the courts because the tech companies have figured out through algorithms how to get these kids, hooked. It's like the food industry. You can take the nacho
Yeah.
cheese Dorito and make
Yeah.
it just the right amount of sugar, the right amount of salt, and make it addictive. And that's what they've done. I think
Yeah.
the good thing, though, what I'm optimistic about is there's been a lot of really good things, changes that happen, particularly in the healthcare. I mean,
Absolutely.
we have these diseases and Parkinson's and Alzheimer's, and my mom suffers from dementia. I don't think it's going to happen overnight, but I think we're going to solve a lot of these real world problems. So that's where I'm optimistic about it.
Absolutely. And I think family offices are so well positioned, especially with their values and what they care about to help advance those things. Like you said, with Michael Milken and again, if we can help support them, we can really put that money, that wealth to good use. Now, you mentioned the foundation, the things that they should do, the steps they should take, and you mentioned philanthropy before investments, and I know that's so important to so many family offices. And actually, next month we'll be featuring one of our members all about how to structure it in a way that gives you more joy and really helps the family make more impact. But an anonymous attendee dropped in the Q&A, are there outlets for charitable sector to be connected to family offices, or is it more typical that a family office will reach out directly to their charities of interest? I'd love to hear your insights, Ron. I mean, I know you work with some amazing, very philanthropic families.
Well, it's a great question, and it's one of the problems. It's sort of like if you're an entrepreneur and you want to work with a family office, or if you have a charity and you want to get access to a family office, there's there's no network. There's no like I can go to PitchBook and I can tell you the top 100 venture capital firms from 1 to 100, the top 100 private equity firms. They don't have that for family offices, right? So there's no list, and I think there should be. And the problem with this is that family offices, first of all, they have the right to be secretive. They can do whatever they want. But if they're going to start competing with the Carlyles and the Blackstones and the KKRs, which I believe is going to happen and is starting to happen, they have to come out and basically say what they're doing. So we have a couple families, large multi-billion dollar families in Chicago. On one piece of paper, they basically write out, and this is done both from a philanthropic standpoint and also from an investment standpoint.
Mhm.
They'll write out, we invest in lower middle market private equity. We don't do real estate in venture capital. We don't do anything pre-seed. And they'll put down, and our average size check is X. We need a board seat. We don't need a board seat. So by doing that, the people, if let's say they invest in med tech, that's their thing.
Right.
Well, the how are the smart people going to find the rich people, and how do the rich people find the smart people? There's no mechanism to do that. And that's one of the things we as an industry need to do is to figure
Help
out a
bridge that
way. Because again, if I'm a brilliant kid at Stanford and I've got a great idea, you just go to NEA or Sequoia and you think you got it set. They're not necessarily the best partners. I mean, family offices, for many reasons, are better partners if they have the right team than these private equity and venture capital firms because we have patient capital and we don't have to flip companies. We don't have a shot clock. We don't have to flip companies every 3 to 5 years just because that's how they're compensated. So I just think that right now there's not enough networking
Yes.
involved. Is for the to find a philanthropy, to find the right donor to do it, or to find the right investor to with the right family office. I think that's going to change, and I think that's starting to change. That again, that's something we're trying to create.
Absolutely. Well, I'm encouraged by the change, and it is incredible technology in this next gen, the digital footprint. And 10 years ago, we had family office list. It was a list of family offices, but without the context, without the trust, without the values alignment, just cold transactional outreach doesn't work in this industry. And so you've taught me just how important the go-giver mentality and the trust factor is. And I do think we really need to flip the playbook. I think too many people enter this world thinking family offices operate just like institutions. And if I send my pitch deck, that's going to be enough. They're going to open my email and want to invest in me. Where the world doesn't work that way. So I'd be curious to hear from you, Ron, just knowing how amazing you are at building relationships and not thinking transactionally, being so generous. I mean, talk to us about how family offices work and how they invest and how they choose and vet their deals.
Great question. And for people who are trying to get access to money from family offices, this is a relationship business. So if a family office is going to invest with you in your good venture or private equity or real estate, whatever it is, the first, second, third thing they want to know is who are you as a person? Can I trust you? Are you a good person? Then they'll diligence you. What's your track record? Where'd you go to school? What's your expertise? That's flipped institutionally. You go to an institution, they want to know what's your 1, 3, 5 year track record, what's your biggest drawdown, and then they'll do a little diligence on you as a person. The biggest difference is that this is a relationship business. And remember, a lot of these family offices weren't created because there's 10,000 families that love to raise money. A lot of
Right.
these family offices were created because they stopped trusting Wall Street, and justifiably. I mean, the
Yeah.
wirehouses, they're not even fiduciaries, which is head
Yes.
scratching. So
Yes.
I think that trust has happened. I think that you're going to see more and more family offices working together. The problem with a lot of the conferences now is, and I'll keynote them, and I'm friends with the people, and they're pay to play conferences. Sort of if somebody's speaking, they spent $25,000 and that's why you're listening to them. So we need to put together a system where family offices can actually learn in a way where they're not just a dollar sign. We put
Absolutely.
together, 5 years ago, I put together the Family Office Initiative at Stanford. We Part of the problem is I've got a syndicate of about 130 families. We invest together in the private markets. These are families between 250 million to 30 billion, and we invest. And I keynote a lot of these conferences, and they'll always say, "Hey, I see you're keynoting this conference. Should I go?" And 99 times out of I'm like, "No, don't go.
Yeah.
Not a good use of your time." Because
Yeah.
what it's become is service providers pitching to service providers, and there's very few family offices. So what I wanted to do 5 years ago is put together a family office conference that I would tell you, Danielle, or the families that we invest with, yeah, you should go to this. So what we did is I went to Kirkland and EY because Ryan Harris runs the family office practice for Kirkland. Bobby
Mhm.
Silver just retired, but he ran the family office practice for EY. And I said, look, you guys do the heavy lifting. I'll do two things. And I put together the family office initiative at Stanford, but I'll put together a conference, but I'll do two things. I will get you world-class speakers and I'll pick the content because I know who the best speakers are and I know what people want to hear. They don't want to be sold. So I'll give you three quick examples. First guy I called is a good friend of mine, Paul Carbone. Paul runs the family for Tony and JB Pritzker. He wasn't pitching a fund. He wasn't raising money. He was just saying, here's how we do due diligence. We start with 200 companies. It goes to 50. It goes to 20. I kind of come in here. We have an investment committee meeting. Then we have to have a two-thirds majority. We need a board seat. We don't need to. All he was doing was saying, we've done fairly well investing on behalf of the Pritzkers, and this is our due diligence process. That's it. There's no agenda. Second
Wow.
example is Tim Callahan, who's a close friend. Tim was Sam Zell's partner, made a fortune in offices. He wasn't raising fund three or fund four or fund five, wasn't raising anything. He was simply opining on what he thought was going to happen to the office market. Because remember, during COVID, we didn't know if people would ever come back to offices. He was just giving his thought leadership without any agenda. And the last example I'll give you is a close friend is Denise Illich, who I think you've met.
Yeah.
They own Little Caesars and a couple sports teams. She, along with Dan Gilbert, helped rebuild Detroit. Now, she wasn't asking people in the conference, donate to my philanthropy to make Detroit better. She's just saying, I don't care what your charity is. You need to run it more like a business. And here's kind of why we've been successful. Here's what we did wrong, but here's what we got right. And the whole message was run your philanthropy, not exactly, but more like a business. We had, there was no ask. We had 880 families from 6 continents on a Zoom call during COVID, 420 over $1 billion. And the reason for that was because it was pure content, pure education. That's what has to happen in this industry. You've got 124 trillion moving downstream. We have to figure out a way to make it more efficient and less siloed and less fragmented. And I think that's going to happen at the university level. That's what we're trying to create.
Well, I love everything you're doing to spearhead it, and it's true. It's, we can't treat this world like the institutions. They don't think that way, so we've got to flip the conferences to be a safe educational space. And that's what, we try so hard to help people understand the framework. It's not about if you go in thinking this is about me, I'm transactional, I need money. Like, why are they going to pay any attention to you? I say, flip the script, start with the end in mind, not your short-term transactional, but their long-term legacy. If you can understand what this family values, and it takes research, and yes, data can help with that, but more importantly, it takes someone who's curious and cares. If you don't care, then no, how are you ever going to make any traction? So I think, yeah, showing up, caring, learning, curious, and education. And that's one of the things, Ron, I know you're so passionate about and something you've been so instrumental in just helping people and everyone on this call. We've got, 182 people right now. So thank you for everything you do. And I have so many of my own questions, but I really want to engage. We have Kate Wilkes. Kate, thank you. She is one of our most regular participants, always has such thoughtful questions. She wants to know, is there a third choice? For example, if there's an exit that yields 50 million and the family doesn't want to use an MFO, how would you guide that family?
Well, first of all, if they sell their company for 50 million, that's a tremendous amount of money. It's just not enough to have a single family office. So they can go to an MFO, they can go to an RIA. I wouldn't go to a wirehouse, which is not even a fiduciary. I mean, the RIA basically had the wirehouses, and then the last 20 years, you've had a huge growth in RIAs. RIAs are at least fiduciaries. You have to do what's in the client's best interest. And even saying that is mind-boggling that the wirehouses aren't even fiduciaries. But then the multifamily offices came in, and it wasn't just about creating alpha and making, getting 12% of your portfolio. It was much more holistic. So they looked at things like trusts and estates and wealth transfer and tax efficiency. And things like that. So more and more the multifamily office. So you can go to a multifamily office, you can go to an RIA. I would not go to a wirehouse because they're paid to sell product. That's what they're doing. I'm not saying there's not good people at some of these firms, but just from a macro standpoint, I think RIA or a multifamily office are the two solutions for that.
Wonderful. I will just do a few more of, I mean, we'll never get through all the questions, but I'll just answer or put a few more before going back to a few of mine. Ryan Mayfield says, given the crossover of the political headwinds with general handoff, what's the state of impact investing? And I know that's something you're also really passionate, not just philanthropy, but really making an impact.
So yeah, so look, I'm definitely for that. I think from a macro standpoint, I think a lot of it, there's a lot of greenwashing. A lot of people will just say, it's just marketing and they're gonna do good and they use it as a way to raise money. So
Yeah.
I think that's the negative side of it. I think the positive side of it is when I was younger, if I needed a pair of jeans, if they fit and they look decent, I'd buy them. And
Right.
if they didn't fit, I wouldn't buy them. My daughters, I've got two beautiful daughters, Zoe and Bella. Zoe's 25 and Bella's 22. They want to buy a pair of jeans. The jeans have to fit and look good. But then they go on their phone and then they can look up how do they treat their employees? What do they pollute? I didn't have,
Different world.
it's not that they're better people than we were in my generation. It's just they have access to the information. So I think that this next generation, because there's so much information out there and they
Yes.
care about it, I think there's more of that. So the impact investing came from the younger generation up, not the older generation
Mhm.
down. And a
Mhm.
lot of the older generation thinks you should have money, your one pool of money just to make money and one pool just for philanthropy and not bridge the two. Some
Mhm.
people think you could bridge the two. I'm kind of in between there. I think you can do it, but I think again, a lot of it is optics and a lot of it is really just greenwashing.
Yeah. You know, the idea of impact investing, it's something that it's always fascinated me. It's actually before Sean Lesser came back and launched the Real Mental Health Foundation. I followed his work at Big Path Capital. And one of the pioneers in the space, Lizel Simmons, who was a Pritzker, and that's what she's passionate about. So she and Ian created Blue Haven Initiative, and this is an interesting trend for a sector that's secretive and private. I've seen those looking to be leaders and pioneer areas they're passionate about are raising their brands. If you go check out their social presence, like their LinkedIn feed is amazing and they're out there talking about things they're passionate about. And so you're right, this digital era is shifting. I think it's becoming increasingly important for families to define if their data is going to be out there, what do I stand for and what's the story around that so that they can attract the right opportunities and the right people for collaborations. So, all right, I was going to go back to mine, but this question is too good. This is actually something Warren, my husband, and I were talking about just yesterday. Leonard asks, what will the name of family offices when they complete, what will be the name of family offices when they completely get institutionalized?
What's interesting is I'm close with Paul Carbone, who runs the family office for Tony and JB Pritzker. Um, they don't even like to call what they do a family office. They call it family capital. And the reason is because most family offices are not run efficiently. They're fragmented, siloed, and inefficient. So it's almost whimsical. So their family capital, they don't want to be called a family office because they don't want to be lumped into that. I think that's going to change, but we're still a far ways away. So
Yeah.
when families are with other real family offices that understand and have the professionalization and the staff. And part of the problem is, a family office today, if a family office, and again, I'm going to generalize, if they pay a kid out of, I went to Northwestern, if they pay a kid out of Northwestern $250,000, not all, but many of these family offices look at that as a cost. In other words, this man or woman is going to cost me 250.
Yes.
I promise you, if Blackstone or KKR or Sequoia or NEA hires a kid out of Northwestern and they pay him $250,000, they don't look at that person as a cost. They look at it as a potential $20 million profit center. That's just one of the things. So if you look at it as a cost,
Hmm.
it's not a business. if you look at it as a potential profit center. So I think that's just one of many examples that families have to get right, which they don't. Some do. I mean, the only reason Tony Pritzker was able to hire Paul is because he was doing phenomenal at Baird, super successful. Um, he figured out a way. You have to have alignment of interest, and you have to compensate these people. So what families have to do, it's not a question of how cheap can I get this person, because you're going to get what you pay for. You
Yes.
have to give them carry. You have to give them lines of credit. You have because they want to do well as well. And the families
Yes.
that get that, which are very few, do extraordinarily well. You need the talent. And in order to get the
Yes.
talent, you need to pay it.
Will that be a part of the long-term framework you help build out through Booth?
Yes.
Amazing. Well, Warren will be happy. He's all about the term family capital. He's bought up all sorts of domains, so I'm glad he's aligned there.
Did he buy Family Capital?
Yes. Okay, smart. So there are a lot of questions. We'll get to them, but I can't let this conversation go without getting your insights, Ron, around AI and how you feel it's impacting the family office sector, whether through the way they're evaluating AI investments or the way they're adopting it to be more efficient. Also, just how you view it if you use AI in your day to day, especially around the work with family offices.
I think AI is going to fundamentally change. I mean, when I gave the person when I gave a lecture at Stanford,
Mhm.
the professor who spoke before me had a picture of fire, a picture of a wheel, the word internet, and the word artificial intelligence. And what he's saying is that's how transformative this is going to be from a societal standpoint.
Yeah.
AI is going to be like the internet on steroids. It's growing so fast. So how are family offices using it? 6 months ago, I met somebody who showed me software, and it was AI. And basically, I looked at it and I was dumbfounded because it looked, I'm a glasses half full person, which is sometimes good and sometimes you got to be thoughtful. But the technology looked unbelievable because it would fundamentally change how family office can invest. And then I asked them to show this to some very large family offices, the multi-billion dollars, and some of these 100, $200 billion MFOs and RAs. What they've done, so it's a company that was started by Joe Lonsdale. Joe is the founder of Adipar and also the founder of Palantir. And he started with a guy named Jake Miller, who was brilliant, came out of Bridgewater, University of Chicago undergraduate. And what they've done is, I think it's going to change the game. So right now, 90% of the time that I or many of the family offices spend of our day is looking at deals, doing diligence. And of that, 90% of those deals you're probably not going to do for various reasons. What they've created through AI is that you can now say, I'm a family office and I only invest in lower middle market manufacturing firms between 2 to 5 million EBITDA based in the Midwest that are not counter-cyclical, and I don't like tobacco and alcohol. Or you make up the analogy. I only invest
Right.
in things that can go up tenfold or whatever. 100% of what you see. So if it's $6 billion, 6 million EBITDA, you're not going to see the deal because you're only 2 to 5. So what it's going to do is rather than having one out of every 100 companies that you'll invest in, every one of these companies now fits exactly where you're looking to go.
Amazing.
Now you're going to invest in maybe one out of three or one out of four.
Mm.
What it's going to do, which is a negative, is it could do it could do in 30 seconds what it would take a 1 to 5 year analyst 2 to 3 weeks to do. Now
Right.
that's on the one hand that's good, on the other hand that's a
Right.
little concerning. But I
Right.
do think it's going to fundamentally change, but it's going to level the playing field. So Paul Carbone's got a team of 65 people. He's got, the Crowns, they got massive
Yes.
teams. How does a family office, a $500 million or $1 billion family office, which again is a ton of money, but how do they compete? They really
Right.
couldn't. They're going to be able to compete much better now through AI. So I think AI is going to fundamentally change how family offices are investing. The company is called Opto Invest, and it literally, I think it'll be transformative. So I'm not a technology person, but when I saw
Yes.
what I did, I chair the advisory board for the company right now, and this is a product that every single person or family or institution that I've shown this to, their question is, all right, what are the costs? That's the question. And I
Just
think it's going to
how
change and it's going to get better and
transformative.
better.
Yeah, that's incredible. That's at we were in Atlanta at one of Neil's events, and one of the opening presentation, Victoria Bills, all about AI allocraft. I mean, such an impressive young woman. So just transformative, because I think about it from the other side, the really impressive founder who's got this deck, but you send it out and there's no way they can't look at everything. If they don't know you, there's no relevance. But if they have tools to help, with that alignment, I just think it's going to be transformative and help on both ends, help bridge that gap. So I'm excited. Cody had told me about the Optic AI is what it's
No,
called.
it's Opto, so it's Opto,
Opto.
optoinvest.com.
Okay,
Um,
amazing.
and again, this is the guy, they came out of stealth. They've been doing it for 5 years. They came
Yeah,
out stealth mode in October. So like nobody's ever heard of this company, but it's a guy who started Adipar and Palantir, and they're using
amazing.
the engineers from Adipar and Palantir to build this. They came out of stealth mode in October, and now I think it'll just fundamentally change. It's geared primarily for the private markets. Public
Okay,
markets are pretty good, but it's geared primarily for the private market. So companies like PitchBook, 5 years won't exist.
amazing. Tell me how many decks do you see come across your desk in a but I don't even want to say month. It's probably like a day, and because just to give people context of how powerful
Well,
this tool can be.
right. I mean, look, you see, not only do you see from people who are looking to raise money from family office, but you also see your neighbor. You also
Mhm.
see your mom's friend who's what you see thousands. I mean, and you just don't have the time to analyze it. So you
Yeah.
have to figure out a filter. What this does, it just basically it creates a filter so that now um, whatever if you I only invest in multifamily real estate in the southeast and I only like B-rated buildings, that's the only thing I'm going to see. So it's going to fundamentally change how much time I spend looking at this. Where before 9 out of 10 things didn't even fit my criteria,
Mhm.
now 100% of what I see will fit my criteria, and
Wow.
then I just have to diligence, do I like the people or do I like the management or like the culture, etc. So it'll be a game changer.
And I'm fascinated too. I wonder if the data reversed to really assess the family office marketplace and where they're allocating and what they're interested to analyze the back end of the data would just be a fascinating analysis of the industry as well. Wow. Well, very cool. Thank you, Ron. Eyal, or no, I'm pronouncing this wrong. It's Eyal Benchwal asks, how are family offices currently redefining risk beyond financial exposure, particularly regarding personal, reputational, and geopolitical?
It's a great question.
Yes.
And we live in like a fishbowl. So something happens, somebody's got a lot of money, all of a sudden it's literally over the internet and everybody knows about it. I think that, because of the speed at which technology and the information that how quickly everything goes, um, families have to be very, very careful. I remember when I did my podcast with Tony Pritzker, he said, it takes generations to create a reputation, and it could take one event to destroy a reputation, particularly when you could see everything and there's so much information coming out. So I think families are very, very cautious, and they have to be and they should be. But it's changed a lot, and it's changed primarily because of technology.
Amazing. Oh my gosh, there are 14 questions in here, and it's hard to prioritize because they're all so good. Maria Dolores, this is something you've spoken about patient capital and obviously how that is a unique characteristic of family offices. So Maria Dolores asks, when you speak about patient capital and building trust, what signals do you personally look for in a founder or an initiative that tell you this is truly long-term stewardship, not just long-term language?
Okay, well, great question. So here's how the private equity model today works. Somebody, a garage door company in Des Moines, Iowa, is going to get bought by a private equity firm. I can tell you approximately within 6 to 12 months when they're going to sell it. Not because I'm so smart, because I know how they're compensated. They're compensated, they're going to flip it in about 5 years. And then what happens is they might sell it to strategic, but oftentimes they'll sell it to a second private equity firm. And I can tell you how long they're going to hold it, about 5, 6 years. So if you look over the course of 20 years, this one company, the garage door company in Des Moines, is going to probably change hands, let's call it 4 times. If you look at the taxes and the friction and the disruption in business versus a family office who has the ability to buy it, hold it, and let it compound, the results aren't even close. It's not subjectively, it's objectively a better model. The problem is, even if it's a better model, if most families can't execute, it's a moot point. And that's kind of where we are. There are some families that can execute, but it's a handful of families. I think more and more will. So I think what's going to happen is the biggest advantage we have as family offices is we have patient capital. There is no shot clock. I don't have to sell it in 5 years because that's how we're compensated. So more and more people will do it. I think if somebody's going to sell a company and they want to make the most money in day one and they don't really care what happens at the company down the road, they're going to always sell to a private equity firm, period. But if their kids are in the business, they're part of a community and a lot of the communities in it, and they want this to last 30, 40 years, while the family office is almost never going to be the highest price, over the next 20 to 30 years, if they have the right team in place, they're
Right.
going to perform much better. So I think people who are looking for legacy are going to go more to family offices. So I just think we're at an inflection point in as the great wealth transfer is actually happening as we speak. So this is happening in real time. So I just think more and more people will look for family offices rather than go, I'll sell it to a private equity firm or I'll sell
Yes.
it to a venture capital firm.
And I'm so glad that people are learning that that world exists and learning the art of working with them. Because I know firsthand from watching Warren sell to private equity, the culture that he built for 14 years, it was really a hard thing to be a part of and to watch. He should have sold to a family office.
Right, and they should, but the problem is like he didn't know. I mean, through you he does, but how do you find these family offices?
General,
So I think that's going to change. I think
I think
more and
so.
more people will be looking at family offices. And again, part of it is incumbent upon the family offices to become more efficient and to get the team together. Because even though it's objectively a better model, if you
Yes.
can't execute, it's a moot point. You're still better off going to a private equity firm. But if you've got the right team in place and the right structure, it is a better model. And I think more and more people, you'll see more and more family offices buying companies.
Exciting. We are at such an exciting point in time to watch it all unfold in real time. All right, Melissa Bletner. So good to have you here, Melissa. Your work combines family office investing across private equity and real assets. So, what trends are you seeing in their appetite for direct investments in experiential hospitality and well-being focused ventures? And then there's a second part of the question. What's the most effective way for sponsors in that sector to identify and build relationships with family offices that are aligned with this long-term purpose-driven capital?
Well, I'll start with the second part of the question first. And the,
Yes.
the answer is we live in a society where everyone wants to get, right? So let's just say, when I used to run a hedge fund. So when I was younger, I'm 30 years old when I started if I knew a family had the ability to invest $10 million in my fund, I go to this lunch and my whole thought process, it's a transactional thing. Didn't make me a bad person. I'm just looking at it through the lens. When do I ask this person for the order? Could you invest $10 million? That's transactional. I think what family offices are looking for, there's ways that you could add value. There's ways that I could add value to a $50 billion family office. How? Introducing to other families. I mean, what happens is figure out a way that you can give something, and you can give to anything. Like the biggest value that I can give, if somebody just sold their company for $3 billion, the biggest value I can do for them is not here's the smartest real estate guy to talk to, or here's the best private equity guy or venture capital guy. It's here's 10 family offices that have been around for 30, 40 years. Talk to them. They don't have an agenda. They're not trying to sell you anything. You learn from the mistakes they made. And many family offices have made a lot of mistakes. Um, Again, family office is the first part of the work. It's family. So there's a lot of ego involved and there's a lot of different things in play. So I think that more and more families are going to really start looking at this thing, the family office space, from a much more efficient standpoint. They're going to become more professionalized, and then we'll be able to compete. Right now, again, even though objectively it's a better model, only a few handful of families can do it, but that's going to change.
Awesome. This next one, I'm going to kind of add a little follow-on question, but an anonymous attendee says, do you see the 68% growth of the family offices as a function of being the trend thing to do or a status decision too often? And I think too, I'm sure you'll touch on this, but I know a lot of times you talk about the family office space and sometimes the demise being the ego of the founder. So talk to us about that, all this growth, what is it tied to? Um, and any elaboration around that area.
So, well, first of all, part of it's tied to you could make the amount you could create an app and make, hundreds of millions of dollars in a year or two. And so the speed at which you can create
Yeah.
wealth now has changed a lot.
I
Um,
agree.
I think, and you touched on it before, I think that the biggest obstacle for most of these family offices, and I say I don't judge anybody, but it's the ego of the founder. I mean, I'm fairly good at a couple things, and I'm really bad at a lot of stuff. Um, because you sell your widget company for $1 billion doesn't mean you have any clue about investing in private equity or venture capital or real estate or after tax investing and tax optimization. So you've got huge amounts of money in inefficient hands, driven a lot by ego. So just because I kind of know how to run a hedge fund, doesn't mean I'm really good at investing in really early stage venture. So outsource that. It doesn't mean you're losing control. It just means you're I just find people that I trust implicitly that are smarter than me in various verticals and work with them. And in the little niche that I know, I'll focus on that. And I think what's going to happen is you're going to start seeing a backlash. So the people who made their money in real estate, where they sold their company for $2 billion and they start investing in private equity and venture capital and all these things, they're now going to say, I've got a domain expertise in real estate. That's what I'm going to do. And I'm going to find the guy who's better than me in venture, better than me in private equity,
Mm,
and outsource it. So that's what's going to have to happen. But a lot of it's driven by ego.
yeah. And I know, I mean, you're a great example of collaboration, Diamond Wealth and the way you collaborate with 100 families so that you can all work and evaluate deals together. I'm encouraged by not only just the education, but the collaboration. And Jim Carroll, Jim is a neighbor, he's over on Kiowa Island, but he asks, about some of the collaborative organizations like Family Office Exchange, Family Office Association, Family Wealth Alliance, Family Office Networks. It goes on and on. I know you are a huge advocate of Tiger 21, but can you talk to us or for families that really want to learn and collaborate, what are some resources? And are they all pretty similar? Or are there big distinctions between them?
Look, in my opinion, because I helped to build it, but I think Tiger 21 is best in class because they're not a pay to play. Literally everything they do at Tiger is just pure content. They're just trying
Yeah.
to educate. So I think that's best. I think the one thing that the absolute pinnacle is what we're doing at the university level. So like at University of Chicago Booth,
Yeah.
we put together, right now the top kids out of Booth or Stanford or Harvard or wherever you name the school, what do they want to do? They want to get into private equity, venture, real estate, hedge fund. Very few people want to get into family offices. They don't even know what a family office is. With 124 trillion moving downstream from baby boomers to the next gen, in my opinion, and I'm correct. I could be wrong time-wise, but I'm right directionally. At some point, 3, 5, 7 years, the first choice of these students is going to be to work for a family office, not a private equity or venture capital firm. So what we did at Booth is we put together, we had no clue how it would do. Paul Carbone, Steve Kaplan, who's one of the top professors at Booth, put together, we kind of whiteboarded it and we did a half a credit course, so we didn't even know if people would know what a family office. The
Right.
family office class sold out quicker than the private equity class.
Wow.
We had
Amazing.
Professor Heaton, who's a phenomenal professor, taught the class. I taught one of the classes. The class that I taught, I gave up. I just said, "Here's my email if you have any questions." There are 65 students. 48 reached out to me, not for a job, just like, "Hey, I like what you were saying about patient capital. I got a job at a private equity firm. Is it too early or whatever?" There's huge demand for this. So we put that together. And then the conference the reason we're able to do this, Tony Pritzker donated 5 million for so it's the Tony Pritzker professorship.
Yeah.
We've got somebody, it'll be announced soon, who's donating
Oh,
$40 million, so it'll be the so-and-so Family Office Initiative. So now, because we've got the endowment model, what do? The speakers are Nobel Prize winners from Booth talking about
amazing.
geopolitics or tariffs or interest rates, behavioral economics, and nobody has to sell anything. It's pure
Oh,
educational. So
finally, this is going to be incredible.
when I announced that we're doing this at Booth, and I just put it on LinkedIn, I got outreach from about a dozen of these massive schools. They're going to do
Yes.
now, in my opinion, and it's fine. In 5 to 7 years, almost every major school, business school, in my opinion, or most of them, are going to have a family office program. Right now, we're the first ones to do it at Stanford and then at Booth, but more and more will do it. And I think that's a good thing for the industry, and we need to have that happen.
Absolutely. You are such a pioneer, Ron. It's amazing. And hopefully, this successful model we can see just replicated. That's amazing. Well, there's a question I can't ignore. Cody Meltzer, he's played such a pivotal role to my growth. And he asks, what's something you learned along the way that you will always hold on to?
Um, I'm going to answer the question, but it has nothing to do with making money or finance. It
I
just has
love
to
that.
it has to do with we're all in this together. I remember when I graduated from, or I was a junior at Northwestern, and I wanted to get an internship. And I called one of my dad. I cold called. I knew him. He knew who I was. I
Right.
called one of my dad's friends and said, "Hey, Mr. I'm going to call him Mr. M." I said, "Mr. M, I'd love to do an internship for you for the summer." Well, there's a pause, and then I'm felt like I'm doing something, we did something wrong, and then there's like, "Does your dad know you're calling me?" I'm like, "No." Right. Look, well, I'm going to tell him. Like, he made me feel this tall.
Wow.
The audacity for you to call me, and all I was doing is ask. I was fairly bright. I was asking him to work for free for his company, and he made that's something that I took with me. And I just said that I would never, under any circumstance, ever make anybody feel like that. Because again, everybody starts somewhere, everybody. And I think it's so important to pay it forward. Even somebody who's in college, a high school kid's going to look up to, how do you get into this college? The high school kid, the junior high kid, we need to pay it forward and understand it's a global village. We're all in this together. And if you look at things through the lens, you need to have a growth mindset. And I think that's something that I learned very early in life. I hope everybody does terrific. I don't, if you just say, I want to do the best or I want to be the best and it is driven by ego, that's a bad way to live your life. If you live your life like you hope everybody succeeds. So that's really the main thing that I learned is basically treating people, how to treat people, and trying to give back in a way that, can benefit people. And I would rather give my daughter a great gift than receive an incredible gift.
Yes. I just love that all of your success didn't change the way you feel or treat people. I think that's just inherent. It's who you are. And I do think that just breeds more success. I mean, obviously there are successful people who don't share the same outlook, but it's just amazing. I mean, you can just see through the relationships you have, the network. I mean, if you needed something from someone, you imagine the army of people that would show up just because that's how you always approach. And I just think it's amazing that that one instance didn't harden you, but rather made you more driven to not be that person. Even, as you grew, you always make time for people and conversations, which is just so admirable, Ron. Which, speaking of time and conversations, it is top of the hour. It's 2 o'clock. There are a lot of questions. Well, there's no way, but do you want to take a few more or shall I schedule a round two?
I'm whatever you want to do. I'm fine. I don't have a hard stop right now, so I'm fine if you want.
All right, let's do three more and then we will create a report with all those we didn't get to. Brian Burke, when families wrestle with living well now and investing in meaningful experiences versus preserving wealth for future generations, what practical framework have you seen work to set boundaries and make decisions repeatable rather than emotional?
It's a great question. It's a
Yeah.
phenomenal question. Not a quick answer to it. I think that experiences, look, you you buy it. We lived in a house, and then I get promoted and I bought a nicer house, and the nicer house is incredible for 2 weeks, and then all of a sudden you take that for granted, and then what? I think that it's the experiences that really matter, and I think more and more people are looking to do that. So you have a great car. I mean, I'm not a car guy, but it's fine. It it's the experiences, like the experiences that you could have with your family and your friends. That's what's meaningful and that's what's lasting. Not there's always going to be somebody with a bigger house, bigger boat, bigger car, bigger whatever. But it's the experiences. And I think we're living in a society now where more and more people are craving these experiences. And I think that I could tell you from a personal standpoint, the best memories I have to do with experiences, not something that I purchased.
Yeah. It's so true. And, we talk about time being one of your biggest assets and how you choose that time and really creating lasting memories. Life is so short. And I think it's amazing, Ron, just the way you value your family and your two daughters. And you just create such amazing experiences for them. And those are the things that matter most at the end of your life, aren't they?
Yeah, but both my daughters did tell me I have no social cues. So put that in context.
All right, so I think this can be our last. Leonard Sespi, if family offices get more and more institutionalized, will they turn transactional like banks, PEVC? It looks like family offices won't only disrupt the PE model, but its very own unique non-transactional model too.
So the question is, are family offices going to?
Seems like it's almost two. Will they turn transactional like banks, PEVC? And then he kind of reflects, it looks like family offices will not only disrupt the PE model, but create a unique non-transactional model. Do you think they can remain, I'm going to rephrase it, can family offices remain non-transactional as they start to institutionalize?
Yes, because again, they're a family and they're not the asset. They're not selling widgets anymore. Their asset is the money, and you want to pass down money from generation one to two to three, but you want to pass it down with values. I mean, the worst thing you could do is raise an entitled kid. I mean,
Yeah.
you need kids who are grateful. So no matter what you have, just be grateful for what you have. And I think and they never gave us a playbook to be a parent. It's a hard, it's a hard
Oh,
thing, particularly with daughters. It's a challenge sometimes. But I think that it's the best part of life, and I think that we need to learn more just to talk to just to listen to other people.
yeah.
We're pretty good at talking. We're not great at listening. I think that was a skill set I didn't have when I was younger. I'm good at it. I'm getting better at it. But just
Yeah.
being able to listen to people, you could learn so much just by listening and not thinking about how am I going to answer the question before they finish the question. So I just think that these are things that are super, super important.
Oh, and I love you did. Rena Hollub asks, do you see family offices evolving towards a more conscious capital model, integrating leadership development, human capital stewardship, long-term societal responsibility into their investment strategy? And I think it's like that word, the stewardship, it has so much to do with the governance in the next gen and, the way that you're able to communicate and I think involve them just becomes so important. And that's where, like you said, even if they professionalize, they won't institutionalize.
Yeah, no, I think, look, they're still families, and I think that they look at things different. They're a family, and they've got kids and grandkids, and they're gonna maybe have great grandkids one day, and they want to pass things down. So I think it's gonna be values. One question I did want to ask you about,
Yeah.
I know you recently sold, you were
Yeah.
purchased, your company was purchased. Tell me about like your new role, because that's like a huge
Yeah.
credit for you.
Thank you. I mean, I feel so grateful. I'm grounding myself in gratitude where there's a little bit of uncertainty. The being the sole decision maker means that I'm meeting new people and learning their ways and adapting. So being resilient and open-minded, all those things are really playing into it. And for me, leaning into my unique ability, what I love most, to kind of lead and help create vision for ISS The parent company stocks 4,000 people, a privately held German company, but my division is ISS Market Intelligence, and they historically have acquired a lot of different data companies, discovery data, being strong in the RIA space, and they have a lot of institutional data and lots of large institutional clients. And so I bring this unique lens of this is the world of private wealth. This is this unique sector of family offices, and how does it intersect, and how do we thoughtfully create not just data but context. And so that's what I'm so passionate about, is really helping people understand. And so conversations like these, Ron, just helping them understand the human level behind these very powerful families is so important. And so that I just hope with a larger team and greater resources, my passion can be amplified.
Well, first, congratulations. And secondly, there's a lot you're adding to the community. So thank you for everything that you do.
Well, thank you so much for today. This has, like always, been an amazing conversation. And thank you everyone for joining. This is just makes it so fun. And I'm sorry to those that whose questions we didn't get to answer, but we will save them. So hopefully we can have a to be continued conversation.
We'll do it again.
Amazing. Thank you, Ron. Thank you so much.
Thank you. Great to see you. Always
All
good to be
right.
with you.
Bye, everyone.